What's up, everybody? Jonathan Rose, owner of Masters in Trading, and today we're going to talk about the yield curve and how the yield curve affects equity prices. So let's go. In front of you, I just went to treasury.gov. Pretty much all of September, 0903 to 0927. These are the yields on all the points of the yield curve going out to 30 years. So we have 1 month, 2 month, 3 month, 2 year, 5 year, 10 year, and 30 year. Here's how to follow the yield curve. The most widely followed relationship is going to be 2s, 10s. Now you can look at 2 year all the way out to 30 year. And you can see the difference. 0903 was 1.47. 30 year is 1.95. So the difference between these two is 0.48. If we go down to 927, it's 1.63 against 2.13. So the difference there is going to be 50. But let's look at 2s, 10s, because that's what's closely monitored. And again, when the yield curve goes inverted, as it has 9 times, within 18 months, we've ended up in a recession 100% of the time. So if you look at 2s, 10s, you can see on 9.3, it was dead flat, 1.47 and 1.47. So as we look at the sheet from the fed.gov website, what I've also done is showed you a chart. And this chart starts 0903 and ends 0927. And so you can see at 0903, the chart of 2s, 10s was right here. But as it starts getting steeper or rallying, the difference between 2-year yields and 10-year yields gets further and further apart. So if we look at 912, we see the 2-year is 1.72 and the 10-year is 1.79. So now there's a 0.7 difference. So the chart is rallying, it's steepening. If we go all the way to 913, now we see the widest or the steepest 2s, 10s was in this very time frame, 1.79 to 1.9. After that, it starts turning, it starts to go lower, it starts to flatten. So if we look at 924, we see it's back down 1.6 to 1.64, a 0.04 difference, almost back to the flatness that we had 0903. And so you may be thinking, Jonathan, this is very well and good. I think I understand that. But who cares, buddy? Why do we have to learn this? So if you are thinking like that, I applaud your curiosity, because this is one of the most important things for traders to learn. Here's why I want you to learn it. In a Fed-driven trade, the yield curve is in charge. And so what I have here is I have the yield curve, and we're viewing it by looking at 2s, 10s. And that's going to be the yellow line. And I overlapped the S&P futures. And that's going to be the purple line, last trade 2968. I did this to show you the strong correlation right now between the behavior of the 2s, 10s spread and the S&P futures. Right now, it's a news-based trade, guys. So back here, as the yield curve, if we look at it from 2s, 10s, was steepening, as those rates were getting further and further apart, what were the S&P futures doing? They were following suit. They were rallying. As soon as the 2s, 10s spread changed and started getting flatter, notice the delayed reaction of the S&P futures. But inevitably, they came to catch up. Right now, the yield curve's in charge. Traders have to learn how to be creative. Look at things from a different perspective. Do things that are different. Don't do what everybody else is doing. This is really important to learn, especially right now because the Fed's in charge and 2s, 10s is driving the equity trade. My name's Jonathan Rose. I'm the owner of Masters in Trading. Hope that helped, guys.